There is a massive tectonic shift in the global financial architecture that is being completely overlooked by everyone. This week, macro analyst Jesse Myers dropped a brilliant structural reality check that cuts straight through the retail fatigue. While the crowd is crying over daily price candles, legendary entities are quietly altering the laws of physics governing global wealth. When you close your eyes, there is only one number you should see in your mind: $500 trillion. That is the size of the global fiat asset reservoir currently sitting inertly in fixed income, bonds, and M2 money supplies. Today, we break down how Michael Saylor and pioneering corporate treasuries have just jammed a massive pipe straight through the legacy financial dam. We analyze the physics of digital credit, dismantle the false narratives surrounding recent tech IPO addressable markets, and map out the actual plumbing of hyperbitcoinization. My name is Newell, and you are welcome back to the Signal and Noise podcast. Let's dive in. To understand what is happening right now, you have to throw out your old retail crypto mental models and think like a physicist. Myers asks us to consider the Hoover Dam. Behind that massive concrete wall sits a reservoir containing 12 terawatt-hours of usable, pent-up hydroelectric energy. To the naked eye, it looks like one big lake, perfectly calm, placid, and still. But that stillness is an illusion. It is a massive wall of stored potential energy. If you stick a heavy pipe through that dam and drop a turbine generator right in the middle of it, letting the water violently release toward a lower energy state, you can generate enough power to light up the city of Las Vegas for 5 straight years. This is the exact financial analog for global capital. Right now, there is roughly $500 trillion parked in global fixed income instruments, bonds, and cash equivalents. This capital isn't there because investors love fiat currency inflation. It's parked there because historically, it provided an acceptable trade-off: minimal nominal risk and low volatility. This $500 trillion reservoir wants better returns, but it is inherently trapped. It is dammed up and walled off by strict corporate mandates, risk management frameworks, and volatility aversion. It cannot legally or structurally just buy raw volatile Bitcoin on a spot exchange. Enter Michael Saylor and the architects of corporate Bitcoin treasuries. They realized that capital, like water, is bound by a financial second law of thermodynamics. It always flows downhill, seeking a lower risk per unit of return, what Wall Street calls a high Sharpe ratio. And they just engineered the ultimate pipe to crack the dam wide open. So how do you meet a $500 trillion institutional reservoir that demands low volatility, low risk, and fiat cash flows when your underlying asset is a volatile, pristine monetary orange coin? You don't force them to change their mandates. You engineer a product that fits their constraints. This is the birth of what Saylor terms digital credit. Look at the new wave of structures deployed by Bitcoin treasury companies. They are issuing structured corporate preferred equity and debt instruments directly to the traditional fixed income markets. These vehicles offer legacy capital exactly what it wants: an institutional-grade, fiat-denominated, fixed annual return, in some cases targeting 11.5%, with volatility that asymptotically approaches zero. To a legacy financial advisor, a double-digit yield with near-zero volatility looks statistically impossible. It shatters standard modern portfolio theory allocation models because its Sharpe ratio is off the charts. But this isn't high-risk inflationary lending or synthetic DeFi leverage. The strategy takes the fiat capital proceeds and immediately ingests them to buy spot Bitcoin, an asset growing at an anticipated 29% compound annual growth rate for the next 2 decades. The energy released by capital flowing out of the high-energy, inflation-decayed fiat reservoir into a low-energy, mathematically perfect monetary equilibrium is captured by the protocol. It powers massive returns for common equity holders while giving fixed-income institutions the safest, highest-yielding, zero-volatility digital credit instrument in human history. The plumbing is actively being installed. This brings us to the ultimate clash of financial metrics dominating the institutional airwaves today: the battle over total addressable market, or TAM. Recently, the SpaceX IPO prospectus caused a massive stir, claiming a staggering combined $28.5 trillion total addressable market, boldly proclaiming it as the largest TAM in human history. But as Myers directly articulates, this calculation is fundamentally flawed because it views the world through the obsolete lens of annual industrial economic activity. It forgets what Bitcoin actually is. Bitcoin's true. TAM isn't a slice of the aerospace, tech, or energy sector. Bitcoin's TAM is all value itself. It is the ultimate denominator. If Bitcoin's TAM is all global wealth, then digital credit, the structured corporate plumbing designed to siphon fiat wealth, commands the second largest TAM in human history, that entire $500 trillion fiat asset reservoir. Let's run the cold conservative math. Bitcoin is currently a modest $1.5 trillion asset class. If these institutional digital credit pipes ingest a tiny, ultra-pessimistic 1% of the fiat reservoir over the coming decades, that is an immediate $5 trillion cash injection directly into the asset. If digital credit appeals to a completely reasonable conservative 10% of that $500 trillion fixed income market, a roaring torrent of $50 trillion will slam directly into Bitcoin. We are talking about $50 trillion of structural, price-insensitive institutional capital bidding for a hard-capped, finite supply. That scale of capital flow doesn't just push prices up, it violently reprices the global economy. Let's bring it all home. The noise. Bitcoin is dead, the cycle is boring, altcoins are bleeding, and retail investors are giving up because the price is moving sideways this month. The signal. You are standing in the earliest stages of the largest monetization megatrend in human history. Wall Street isn't just playing with ETFs anymore. Corporate treasuries are actively drilling holes through the $500 trillion legacy fiat dam using digital credit rails. In 2000, dot-com IPOs marked the peak of a speculative retail bubble. In 2021, speculative SPACs and tech IPOs served as an institutional exit hatch to dump overvalued tech onto retail buyers. But this time, the playbook has completely inverted. Bitcoin treasury companies are creating products to legally siphon institutional capital out of the dying fiat reservoir. Digital credit is the structural plumbing of hyperbitcoinization. The pipe has been laid, the water is beginning to move, and capital is flowing downhill. The only question left is, do you see it yet, or will you have to watch it play out first? Stay sharp, stay focused. That's it for this edition of the Signal and Noise podcast. My name is Noel. Please like and subscribe. Stop watching the daily candles and start watching the size of the reservoir. We'll see you on the next block.